Good morning, everyone. This is actually quite an honor for me. I get to moderate this rock band of rock stars that I've brought from all over the country to talk a little bit about the competition for capital. We're really excited about this panel. I think Mike Ming and I talked about it in advance and said that we couldn't be more fortunate to have this distinguished group to come and talk about the competition for capital. Daniel mentioned about the Energy Institute and the mission of the Institute and the things that we've been trying to do over the last 5 years. We've taken on some of the more controversial subjects, whether it be the handling of fresh water by the industry or induced seismicity that Dr. Zorbach played a key role in. We pride ourselves in taking on those issues in a way that constructively looks at the science and lets the science take us to where we need to be. And that conversation has not always been very popular, but it's one that we feel it's about doing the right thing in the industry. And as you can tell by Dr. Zorbach's comments, the industry is very well positioned. We're well positioned to be a part of the solution. But the solution will only happen if we acknowledge the science, we acknowledge our role, and step up and take a meaningful leadership position. We have to acknowledge that there is climate change science that supports the issues that are being concerned around warming. We have to acknowledge there's a role for renewables and likely a role for nuclear as well. That the key here is to embrace the rapidly changing technology in all areas of energy development. You know, it's interesting, only 10 years ago, none of us saw the shale revolution coming. I mean, just think about all the changes we've seen in just the last decade. Now, what does that mean for the next decade? There's a lot of uncertainty, a lot of unknowns, but there's no question that the oil and gas industry has to play a leadership role. Today's panel is designed to talk about the competition for capital. There's a lot of misinformation out there. People are of the opinion that, you know, capital is deployed in some kind of shady way and that we don't really have an idea of what's driving it. Is it the economics? Is it tax benefits? What are the unknowns that are, is it policy being driven like we talked about in the state of California? The reality is I have a group of panelists here today that are the decision makers. These are the people who make the decision as to where they're going to deploy their capital, and I wanted them to share with you their ideas as to what drives it. So without any further ado, I want to talk about my panelists. I'm going to introduce all three. Each of them will have an opening remark, and then we're going to take questions from the audience. I will remind everyone that this is a webcast, so we'll ask our panelists to use their microphones. If we have questions from the audience, we'll hopefully get you some kind of microphone as well so that we will be sure that people watching this online are able to hear it. So joining me first at the very far end is Maynard Holt, CEO of Tudor, Pickering, Holt. Maynard has a BA in economics and speaks Russian, so I guess we have that going for us. If we need to
only after I drink a lot do I speak Russian pretty well.
Okay, good. My guess is if you speak Russian, you know what vodka tastes like. So all of this is from Rice, an MS in public policy from Harvard. One of the things that if you Google Maynard and learn a little bit about him, he's an outspoken industry leader on the role technology plays. And so I find his comments fascinating. In the middle is Matt Harris, a close personal friend and somebody who's been involved in business with me since the early 90s. I guess is the first time we met. Founding partner of Global Infrastructure Partners. He's on the boards of EnLink, Freeport LNG, Hess Infrastructure Partners. He has a Bachelor of Arts from Political Science from University of California. Matt manages, with his firm, over $60 billion in investments, of which renewables is playing an increasing role on a global basis. And then finally, we have O Sullivan, Senior Vice President of NextEra Energy Partners. He has a BS in Civil Engineering from Notre Dame, an MBA from the University of Chicago. The interesting part about NextEra is they have over 21,000 megawatts, and they're the largest generator of renewable energy in the world. So with that said, I'll turn it over to Maynard for some opening remarks.
Sure. Well, thank you, Mike. Thanks to everyone who pulled this together and who's participating. You know, Mike referenced it. Our firm is very similar to a typical oil and gas company, which is up until about 3 or 4 years ago, we really weren't steeped in all the issues and excitement of the day. And we started changing because the world was getting more interesting, and the more we started looking into energy technology, the more excited we got. And so we today have, we have about 160 people, but 4 people do nothing but roam around the world looking at how energy technology is changing. And this has dramatically changed our firm. It's dramatically changed how we think. It's dramatically changed how we talk to clients. It's dramatically changed how we think about the future. And so we're going to get into all that stuff. I thought Dr. Zobak's lead-in was fantastic. And I think Mike touched on it too, which is, you know, there's a view of the world which is that oil and gas is sort of the buggy whip industry, and just as soon as we figure out something else to do, we'll leave it behind. The reality is it's an incredibly important industry. It's going to play a huge role in the world, and in fact, what is stunning is it's going to play a huge role in making the world better, right? And so, and visions, just to Mike's point about what the world looks like in 10 years, will all be wrong if we all got out a piece of paper and guessed that. And so, oil and gas and technology and all the skills that the industry has, I think it's going to be stunning to us how many young people are going to be drawn to it and what an important role it's going to play that nobody's really anticipating right now.
Well said, Maynard. Matt, give us your perspective.
Well, thank you, Mike, and it's a pleasure to be here. Thank you to everyone who's helped put this on and all the effort that's gone into it. We're here to talk about energy today. Energy is a central part of what we do at GIP. We have 3 sectors that we invest in: energy, transportation, and water and waste. Within energy, we're focused on 6 primary areas: crude oil and refined product, natural gas, electricity, LNG, metals and mining, and petrochemicals. And we focus on the infrastructure that enables all of that upstream product to get to market. It's going to be pipelines, processing, fractionation, storage, transmission, distribution. We oriented ourselves this way when we started back in 2005 because we felt there was a hole in the market for a dedicated provider of infrastructure capital. And over the last 14 or so years, we've been able to carve out a niche for ourselves focused on just that. When you think about competition for capital, there's a lot of it, despite the fact that the industry is so dynamic today and is undergoing a tremendous amount of change. And our focus in trying to put capital to work is thinking about it as follows: what do we want to own? What do we actually want to own as opposed to what's for sale? And I tell my folks all the time, focus thematically on what you see driving the industry today. Is it the globalization of the gas markets? Is it the decreasing cost of renewable energy? Is it all the infrastructure that is needed to enable all of the shale oil and shale gas to be commercialized? Is it the dislocation in the traditional utility model today? What about all of that excites you? What gets you excited when you get up in the morning? What do you want to own as opposed to what's for sale today? And then focus on how to structure and execute a campaign plan to demonstrate why GIP is the right partner for somebody when they're thinking about how they monetize or redeploy capital. We try to do that every day, and we try to bring our operational capability. What we've discovered over the years of investing is that infrastructure, whether it's in energy or any other area, has not typically been a focus of the upstream producer. And so we've been able to bring a whole series of operational techniques to help producers and help ourselves to be more efficient. So when we think about it, we think about those 2 things, and we use that to differentiate ourselves to our partners in what is a very competitive marketplace despite all the change that's going on.
Well said, Matt. Mike?
Thanks for having me today. It's always a pleasure for a domer to show up in Oklahoma and not get run out of town. So thanks for having me. I represent perhaps the largest company 90% of you in this room have never heard of. We're a 90 billion market cap company that is the largest utility company in the world by market cap globally, and probably for about 5 years now. We've invested almost, in my 18 years, I've had the same job for 18 years, so we can decide later during the coffee break, whether that's a good thing or a bad thing about me professionally, but we'll get into that later. But I've had the same job for 18 years since '01. In that time, we've invested through a blue pen or two on my desk over $40 billion into renewables. And you would sit here today and go, okay, Mike's the token renewable guy to balance all this oil and gas stuff in Oklahoma. And I relish the opportunity. And it's not to convert you and make you green, because we're not a green company. We're a financially oriented investment infrastructure company those are the buzzwords today, but we didn't use them back then, and we're not using them that often internally. We're the second largest investor, we're between the second and fourth largest CapEx investor in the United States the last 5 years, and probably if we went back and looked larger, we'd probably be that. When you look at who's investing 10 to 15 billion a year in the United States each and every year, it's Verizon, AT&T, Amazon, us, and a couple of technology companies in the US. Others are investing sizable capital all over the world. I'm not trying to say we're competing with the BPs or the Exxons in nominal dollars. Another thing, why we're investing in renewables, we've been doing it for about 20 years now, or 19 years, is it's good business for our customers, and it's good business for our investors. We had no idea the whole sustainability thing was going to happen the last 5 or 10 years. We had no idea Al Gore was going to get in the White House with Mr. Clinton and then pass off to Mr. Obama. We had no idea public policy was going to change and go green. We were already in it, and we probably had 5, 10, or 12 billion into renewables before all that happened. And the point I'm trying to make is we've been investing on behalf of our shareholders in renewables. It's good for cash returns and good front-end loaded GAAP returns for a publicly traded, EPS-oriented company. That's why we got into wind. All this other stuff happened after we made a foothold or a beachhead or built a moat around it. The other thing I think is most important for deploying capital or attracting capital and continue to earn the respect of such investors, whether that's publicly traded capital or private equity capital or venture capital, is you got to have a management team or a business model or a business plan that is sustainable, and not in the way most college campuses use the word sustainable anymore, is credibility and success, and it makes sense. And our fundamental belief is if we're investing at a good return and we're lowering customer bills at the same time, we're going to be fine. Because ultimately our company is two large companies, the large renewable and nuclear company that has assets in 35 states now, and Oklahoma has several billion of investment here in this state. And then in Florida, we serve about 60% of the electrons that go through the meters, and if not too many of you probably, when I speak in the Northeast, I get a lot of folks that have a condo or something in Boca or Miami, but the point being is we have the traditional utility model in Florida, which is about 60 or 65% of our earnings in EBITDA. So with that, we have that mindset to do what's right for the customer and the investor, and I think that's why we've been a reasonably successful company the last 10 or 20 years.
Thank you, Mike. So as the audience here in the room warms up, I do really believe we have a floating microphone, if I'm not mistaken, if we need one. But before we do, I solicited some questions from our students at the University of Oklahoma, and obviously, Maynard, they see your comment as the most powerful one, and I'd love you to elaborate a little bit. Why does a student pick the energy industry today, from your perspective?
You know, I think that there's probably a few reasons. One is it's dynamic, and it's challenging, and it's interesting, and it's hard. And if you can, because what we're setting up, I think, is you think about the challenge of the next, we'll call it 20 years. We've got people who don't have power now, globally. So we've got to get power to them. We have more people coming. Okay, we're going to have to get power to them. So we're going to need a massive increase in power globally. And we not only have to add that power in a clean way, we have to clean up the power we're already using. And so this is a huge, you know, the goal is subject to, subject to, subject to. And when you look at that, the only way to do it is two ways. One, you're going to have to challenge a lot of the assumptions that you have, right? Because it doesn't work, right? You look at some of this stuff and say, okay, it's not going to work if we just do it the old-fashioned way. And then, you know, the corollary to that is there's going to be a lot of technology. There's going to be a lot of change. So this problem should draw the biggest brains in the world. It is also a, forgive me for saying, it's a moral problem, right? It's a problem that has, you know, the comment about how many people die from smoke that comes from using wood, okay? The problem of the environment and passing on to future generations the globe in a way that is responsible. So this has got to be, you know, the challenge of the next, I said 20 years, call it the next century. This is it. And usually that draws, you know, I'm used to hearing people talking about millennials and trying to understand them and how should we relate to them. And you know, the thing that I find really striking about millennials is they would like a job with a purpose. They don't just want to pay off their college debt and pay back their parents, and they don't think in the practical ways that a lot of us thought. And so sometimes we look at them and say, oh, you know. But what's interesting about them, though, is they say, I would like a job with a purpose. I would like to know that when I'm coming in the morning or staying until 4 a.m. or whatever I'm doing, I would like to have a purpose to my life. And so energy and that concoction I just went through, there's no better one. Like, you want a purpose? We got a purpose. And so I think that's why the industry, you know, we got to work on how we're marketing that, and we got to, I think a lot of the business models are going to change. But I would dare say 99% of this year's senior class in colleges around the world, none of them have thought the oil and gas industry might be the industry that re-injects CO2 and makes the world a better place long before a lot of other industries do so. They haven't thought that. And so we got to work on the message, but I think at the heart of it, if you want to challenge, energy is going to be top of the list.
Well said. So Matt, when we think about these young people coming out and engaging in this moral purpose, don't take a lot of money. And when I see the numbers that Mark shared, trillions of dollars and lots of new infrastructure, I guess two questions for you, Matt. Is there enough capital? And is the competition for capital such that it will find its way to this space?
I think the answer to both of those questions is definitively yes. It is going to take a lot of money. There's no question about it. Some of that will come from government in the form of incentives and other things. But you know, I certainly believe that private capital and partnerships between governments, communities, and the private sector are going to be central to this energy development that we see over the balance of this century. I'm in the world of private equity. Private equity is one of many alternative asset classes, and candidly, the returns in alternatives have been better than just about anything else out there, whether it's fixed income, public equities, hedge funds. So I think when investors, pension funds, the large investors in the world, the sovereign wealth funds will continue to be attracted to alternatives, and this is a great place for alternatives to put money to work. Maynard touched on this, but you know, at the end of the day, energy and energy development is still the best way to lift countries and populations out of poverty. And we're in a world today where globalization is upon us, And it's an unbelievable opportunity to use that globalization of the energy industry, just look at LNG, as a way to deploy the potential for lifting societies out of poverty. So no question that the capital is out there. Will it find its way to this industry? Yeah, I think it will. You know, it's interesting because there's a lot of change happening in the energy industry today. You've got you know, all types of different issues around decarbonization and how large oil companies, small oil companies are going to position themselves for this energy transition, moving away from being entirely dependent on fossil fuels to, you know, a business model that's more focused on energy and electrification. The margins in that business, in those businesses, are different from what's in oil and gas. You know, operating a utility scale solar business once it's operating is different than exploring and developing a large offshore oil field. So the returns are different. And if you're Total or BP or Shell, how do you manage that transition in terms of returns? When we look at this, we see all this dislocation, but we also see opportunity. There's always opportunity in dislocation. I think you have to stick to your knitting, and you have to make sure that you're true to what you believe and why you're investing in the first place. But as I see it, we have an unbelievably dynamic opportunity to deploy capital over the next 25 years. And if you manage that transition well, there are great opportunities to make money for your investors.
Well said. So Mike, from a public company perspective, kind of the same question. You all have been a leader here domestically in embracing the renewable investment, but it sounds like it's more from a financial wealth gain perspective than it was an intent to be green. Tell us more about what you see the investments are going to look like and the competition of capital here in the U.S.
First, let me position it. I think we're the second largest burner of natural gas in Florida, in the country, as far as volume. And that's not going to change, right? And we own 8 nuclear units, and that's not going to, well, we're retiring 1 next year. But on the capital, the flow of capital, I would second what Matt said and maybe say there's too much capital flowing into our sector as far as renewables and power generation, we'll call it. And that's, and I can support that under the premise that returns are unbelievably optimistic and low. The amount of money flying into the U.S. into renewable technology or in the M&A market, the spread between that and the greenfield original risk decision is the widest I've seen in my 37 years, or let's say the 18 years I've been doing renewables. And what a greenfield effort will make a 10 or 12% unlevered tax-efficient return, and the M&A market is clearing at 4 or 5% on the same assumptions. That's an arbitrage gap that says there's excess capital somewhere or it's chasing yield. And we're in a low yield environment globally in all asset classes. And how long that persists, I'm not smart enough to tell you today, and I doubt anybody here is, and I'm not trying to insult anybody. I'm just trying to point out that you have a lot of capital flowing into things, and everybody thinks they're smart enough to get out when the bubble bursts. And I'm not saying it's a bubble either, because Japan's had low interest rates or a low yield environment for 20 or 30 years, and there's other economies that are paying negative interest rates in Western Europe. And my point is in our sector, there are a lot of people flowing capital in, and maybe on a risk-adjusted basis, it's better than their alternatives or what they can hold at pension funds or sovereign wealth funds or other entities that are behind all these vehicles. And that's flowing there's plenty of liquidity. This is not a liquid industry either. It's not something you can buy and sell quickly other than ETFs and common stocks or bonds. And these decisions take months, and the due diligence to make the investments is often millions of dollars by a lot of these M&A type entities that are buying these projects later in their gestation periods. And in our business, it's gotten more expensive, difficult. I was listening to the opening speaker about how hard it is to do oil and gas and fracking and shale gas around the country. I said, welcome to our world trying to permit a goofy wind or solar facility. In rural America, we were welcomed with warm arms, open arms 10 or 20 years ago. Today, we have a battle in almost every state, including here in Oklahoma. We have landowners in rural Oklahoma fighting wind farms that today Oklahoma is the second or third largest state in the country as far as percentage penetration of wind energy to the grid, for the total retail load. So everybody, almost everybody is fighting everything, and that's a risk premium that needs to be acknowledged as capital flows into those sectors, as new investment, whether it's oil and gas or renewables. And I think most people are discounting those risks a little too lightly as I see capital flow in. And not saying all of us are conservative or all of us are right, but I believe the general trend to get into renewables or get into alternative energy and get into something other than oil and gas for ESG reasons or green reasons or sustainability reasons or annual report reasons is noteworthy and probably positive, but I often think the professionals behind it are not digging or peeling the onion back far enough to understand what they're buying or what they're investing in.
Well said. I'm going to pose one question, last question from me to all three of our panelists, and then I'd like to take questions. So please raise your hand if you have a question for our panelists so we can get a microphone to you as I pose this last question. So obviously energy has got many facets, both from a demand-side management, efficiency, technology is going to be developed on not only the supply with renewables and battery storage, and wind's going to have its challenges, but they all have their own unique cross to bear. One of the things that the president said here recently, and rarely do I comment on Donald Trump's wisdom, but this time I will, but I will tell you that he made a comment to a group of executives from the oil and gas sector in an API meeting that I thought is important, and I'd share it with this group to see how you all feel. He says it's time for the energy companies to get their act together and work together, whether it be fossil fuel, renewable, utilities, etc., and create a common message, a common united front. How do you all feel about our ability to work together across these various different areas of expertise in order to be constructive in public policy?
Well, I'm happy to keep the same order. Yes. Let the guys come up with better answers. But I think what I've noticed, and Mike just mentioned ESG, so environmental, social, governance pressures that investors are putting on companies, it's really starting to change the landscape, and it could result in us getting a landscape that is a lot like what the president just described. So forever we've had this world of there's the oil and gas guys over here and there's the renewable guys over here, and the oil and gas guys get their money here and the renewables guys get their money here, and this is the way we've done things. And then the majors started doing, of course, some renewables, and but what we're noticing now is the beginning of a real change. And the change is this. First of all, any energy company, but particularly fossil fuel companies or service companies, they say, I'm going to get cleaner. I'm going to get cleaner. I am going to find a way to get cleaner. So technologies and processes that make me cleaner, I want those. I'm going to find those. And the other one is they have to, it's been a rough patch in oil and gas, honestly, because of all the success we've had finding so much of it, but they're also going to try to get more efficient. So the punchline on this, and I happened to be at CERA this year, and Bob Dudley from BP made a great comment that I thought was really interesting. He said, why do I care if it's solar or if it's wind or if it's oil and gas or whatever? That's just the flavor. What I care about is how much energy did you make, how much money did you make, and what was the impact or footprint of your processes, production, and activities. So why do we keep talking about this? And I think it sets up an interesting thing. We're in the M&A business, and so in the M&A business, if you think of this a little bit in an M&A context, what does the existing large, well-capitalized company do when a smaller, unique technology, undercapitalized still in the process of development competitor comes along, you buy them. And so I kind of think what's happening is it is going to become one community, and oil and gas companies are going to use solar at the well site and all kinds of things like that, because I think the world is moving to, instead of thinking, we used to do the dirty thing and we're going to move to the clean thing, I think the thinking is becoming a lot of, we're all going to the clean thing. And by the way, different energy, different ways of producing power, that is a site-specific, use-specific, situation-specific thing. It is not always the right answer to use one flavor or another. So we have to become more adaptable in how we think about flavors. So I think, I don't know what the president had in mind when he was barking at the oil and gas guys, but he has a point, because it's starting to happen. The number of really small companies who are thinking about, how do I get cleaner? How do I tell my investors that I'm doing better on all these things that we all care about? It's happening, and I think it's going to change the form of what we think of as an energy company dramatically over the next decade.
Matt?
I think it's a great question. And I'm very optimistic about all of the constituencies that make up this, this issue working together. It's early days, but it feels to me like government is finally starting to focus on this issue in a somewhat bipartisan way. I think we're starting to see the seeds of that. I think the point that Maynard raised about investors is critically important. And you've seen evidence of that recently. Probably the most significant piece of that was the investor base of Shell requiring that the pay of the Shell executives be linked to achievement of their decarbonization plan. We're seeing it. We're raising a new $20 billion fund, and for the first time, we are having investors really scrutinize us as it relates to the carbon footprint of our portfolio. What does it look like today? What is it going to look like in 10 years? And are you prepared to commit to that plan? And for the first time, we had 3 investors, very large investors, mostly focused on the west coast of the United States and in Europe, ask us for exemptions from any investments we make in infrastructure that carries hydrocarbons that have been produced through hydraulic fracturing. And the institutions are name brand institutions. Now, our own view is that the transition that we make to cleaner energy has to be accomplished within the envelope of the hydrocarbon industry. We are not going to turn off hydrocarbons and turn on 100% renewable energy by 2030. It's not going to happen. But we do have to work together in order to accomplish that. The other thing that I think is going to drive this is the investor perspective, not just on ESG and social good, but on profits. One of the things that we're really focused on in this next fund is, as I look at an oil pipeline, I'm going to probably be pretty comfortable if I do my homework based on the basin and the customer, that the cash flows that I expect to achieve during the life of that asset and the ownership of it I have are going to be good. But what is much more uncertain, and I know we're focused on, I know our investors are focused on, and I know investors of other big oil and gas companies are focused on, is when I go to sell that asset in 7 years or 8 years, and if I had assumed that I was going to make 10 times for it, but the investor sentiment has changed, and the investor that I'm going to sell to is only going to pay 8 times for it, because for whatever reason they see clean energy coming quicker, or they see more regulation, they see a carbon tax, whatever it is, then that's a problem. So we're spending a lot of time trying to think about how we bridge that gap over that period of ownership. And I know the same thing is happening. I'm going down to see Exxon next week. I know they're very focused on, and I know their investors are focused on, how do I make sure that I don't end up with a degraded asset as this transition takes place. So I think all these forces, economic, social, political, will come together. It's never easy. There's a lot of awkward moments. But I believe that everyone will come together, and we're an incredibly resilient species. We will find solutions through technology and other means that find a solution to this issue of CO2 and climate change.
Mike?
I think everybody's crazy thinking that we're all going to sing Kumbaya and get along. Two premises. In the electric industry, we're 50 different states in the United States. Many of you don't know this, the president doesn't know this, and maybe 200 people in our industry understand this, and only 10 will probably get what I'm talking about. And I'm not trying to stake. We are 50 different countries when it comes to electric policy. What Oklahoma does doesn't coordinate with Texas. What Florida does doesn't even speak to the people in Georgia. And Nevada doesn't even know where California is when it comes to electricity. Many of you in this room think of electricity as this harmonized grid, which it is, but like the interstate highway system got built, we all lean on each other, we pay a federal gas tax, we pay state gas taxes, and we all get to use that system like a grid daily for commerce and for personal travel without really caring which state built which pavement, because it's all kind of standardized. And the electric grid is built the same way with one caveat. It was built in each of the 50 states to run the electricity in those states, and then over a few decades, 50 or 75 years ago, we ran a line to the adjacent state every now and then for an emergency. It was not meant for wholesale trading and moving of power. Over the years, that's adjusted or tweaked a little bit, but that is not going to change in the lifetime of anybody in this room, especially maybe some of the students that are in this room that are a lot younger than I am. It's not going to change. So we're not going to sing Kumbaya on the electric side and all get along corporately with the oil and gas business. We're going to coexist. We're going to find technology and ways to lower the customer bill, where I think he was going on, if the price is the right price, and when you impact all the other social issues and public policy issues, it's the right decision for society, whatever country or state you may be in, people will make better decisions, more informed decisions on which technology to go for. And here's the financial reason it's not going to happen. The CFO of BP or Devon or Continental or Exxon or Chevron, well, Chevron might be a little distracted this week on what's going on in the newspaper, but even an electric schmuck like me knows what's going on in the oil and gas business. Those men and women, when you march into their office and you want $1 billion or $10 billion or $100 million to invest in some new technology, whether it's wind or solar or oil and gas or whatever, they have an IRR or hurdle rate or risk premium they want for the shareholder capital, because it's pretty much an all-equity bet. When you walk into our CFO's office, or I have done at least for the last 18 years, we have the same dynamic, same capital approval process. Whether you're investing in a natural gas plant in South Florida to keep the lights on in Miami, or we're investing in a wind farm here in the wonderful state of Oklahoma, it's the same process. What's our cost of capital? What's the premium, Mike, you're going to bring to us? And what's the risk that you screw it up? In our sector, that risk premium is pretty thin, as evidenced by some of the projects his sector is buying into our projects. It's a very compressed range of returns. It's not a very large risk premium because of the way our financial structure is on the electric side of the energy industry. But the oil and gas industry has a far wider risk premium. And that CFO, that man or woman, globally or here domestically, occasionally will let a little token wind or solar project get invested in for other reasons by an oil and gas company. It is not for shareholder value. We don't compete with these folks. We don't see them because they have much bigger elephants to drill for or explore for or find or capital deploy, and much higher premium returns they have to earn, because when they miss, it's billions. When I miss, it's hundreds of thousands if I'm doing my job right, and if I have a bad year, it's $1 million or $2 million. And we deploy a lot of, $4 or $5 billion a year in renewables. and tens of millions or hundreds of millions of what I'll call G&A to try to make it work every year, overhead to make it work. But in the oil and gas industry, it's an extra zero every decision, perhaps the bigger decisions. Maybe not the fracking and the shale gas in a more distributed way. But those return expectations are such a premium to what the electric sectors look for. I don't see those converging. I don't see capital markets converging on that. I don't see everybody singing Kumbaya and say we're all in the same thing. Let's take a lower return, oil and gas shareholders, because we got to save the planet. I don't see that happening in capitalism. I'm not saying it's right or wrong. I just don't see it happen.
I just, I mean, I think Mike's making some great points. I'd say what's interesting, you know, everybody knows that great story about the two guys hunting, and the one guy starts putting on sneakers, and the other guy says, you're not going to be able to outrun the bear, okay? And he says, I don't have to, I just have to outrun you. So a lot of that's going on in oil and gas, and here's the way that analogy works, which is, as an oil and gas company, you know, I'm never going to be like afforded the save the planet premium. I'm not going to have that level of interest in me. But if I'm the cleanest oil and gas company, I am going to draw more capital than someone who's not. And so if you're an oil and gas company that goes to Europe and you don't have an ESG report and you don't maybe have a little bit of solar here and there and you don't have methane monitoring, capturing, so on and so forth, if you don't have that and do that, you're not going to get any meetings. And so an entire continent is not going to listen to you. And so a lot of oil and gas companies, again, it's the same thing. Like, I'm not going to be the cleanest guy on the planet, but I'm going to lead my sector. The biggest problem that oil and gas has, I think there's a lot of social pressures around investing in oil and gas. But the biggest problem that oil and gas has is it hasn't made money. How many of you own energy stocks? Okay, are you happy with those investments? You don't have to answer. So you can imagine in today's world, if someone walks in and says, you know, we're not making money in this oil and gas thing. It's been 5 years. The stocks are down to, at best, sideways. And someone says, you know, I've got it. Let's announce that we're no longer going to invest in that dirty, awful thing called oil and gas. And everybody says, this is awesome. This is a winner, right? Because they don't want to do it anyway. It's not making money. So it gets back to the point about you got to make money and you have to be cleaner. I think the last point that's really interesting, and it illustrates how capital markets are very different. I totally agree with everybody wants to make money, but let's say you're an oil and gas company and you're producing oil and gas, and to the earlier discussion, you had another division that was taking CO2 and sequestering it. If that second division grows over time and you were to take it public, the line to invest in that company would be like down the street, around the block, you know, to the end, all the way to Oregon, right? Because there is a strong social taste in what you own. And, you know, a lot of people, we always talk about shale is the source rock. Well, the source rock in the financial community is, you know, universities, pensions, a lot of capital like that. And they have a strong view on what they would like to be invested in. And that taste shows up in where it is easier to get money or where it is harder. And so I do think we're going to see some real changes. And I do think it's quite striking the amount of capital right now that would like to do the right thing. That's a strong sentiment in today's world. And it means as a company, if you're doing the right thing, as defined, then you're going to draw more capital than someone who's perceived to be not.
Thank you. Let's open up for questions in the audience. Anybody want to raise their hand and ask a question? Got one right over here.
I'd like to, Mike, you touched on this. I'm less concerned about capital and technology than I am about public policy. When we can't even get a natural gas line laid through New York to help the people in New England, how the heck are we going to get a bunch of CO2 lines laid to West Texas, to the Permian, through a variety of states, because that CO2 is generated not in West Texas. And oh, by the way, we're doing this for the good of the planet, but it'll also increase oil production by 50%. That's going to sound very self-serving, and our industry is not liked. I don't see how we change public policy without stronger eminent domain requirements. I don't see us getting there. I don't know how you change those attitudes to allow us to use the technology and the capital that we have to make a difference.
Well, I agree. We have our own pipeline that's delayed coming from the Northeast down towards the South. So we're living that dream every day. And the public policy part is only getting harder. People think because we invest more than probably anybody else in renewables that we understand how the Ds think. We're as perplexed by the Ds as the Rs. And the biggest change I've seen in our company in the last 10 years by our chairman is a commitment to have boots on the ground to understand public policy in each and every state. Because it is a state-by-state discussion. The federal government is not going to step in and just blindly make policy when it comes to energy. Oil and gas, maybe, because of pipelines being interstate, maybe due to some issues around the use on the retail side, because oil and gas is a lot more complicated from upstream, midstream, all the way down to the retail level. But on the electric side, when we consume natural gas in our sector, when we do things, for example, you touched on something on sequestration or injection. One of the biggest mistakes in our industry the last 3 to 5 years is our friends in Mississippi, actually it was a Mississippi project by our friends in Atlanta, one of the largest, most successful utility companies in our space the last 25 years, made a $7 billion mistake on a 545 megawatt now combined cycle project that should have been built for $400 million, but they spent $7 billion trying to inject it in the ground and use, to be green. They started out telling everybody it was $2 billion. Talk about state public policy. They convinced the regulators in Mississippi to do that 10 years ago. And they kept kicking the can down the road and finally abandoned the project. Now it's a 545 megawatt combined cycle plant that can't do the high-tech stuff. So as far as capital chasing interesting green ideas, sure, but that's venture capital, that's private equity should be making that bet. And that's the separation we've had, the sophistication we've made as an industry the last 10 years. This type of discussion we're having today wouldn't have happened 15 years ago. There was no R&D going on in our space on the electric side. This much. Utilities aren't in the business of doing R&D. That's what private equity and venture capital and Silicon Valley have created globally and narrowly in the energy space the last 10 or 15 years. And it's the right way to do it. It's the right way for that risk capital goal. But back to the public policy, it is true Rubik's Cube of how we decide where we go and what states we put investment in. And there are certain states, 25 states, I won't even try to permit a wind farm in right now. We don't have anybody on the ground even chasing wind farm opportunities for the next 5 or 10 years. Because we just know it's crazy. It's nuts. I don't mean crazy economic. I mean just crazy. We're just not going to get the permits, whether it's the state level, the county level, or the local level. And public policy has been emboldened, which I think is good from a democracy point of view. I hate to see it because it costs me money and drives me nuts, commercially speaking. But what we've done is we've allowed people to speak, whether it's the internet or public hearings. Those things have been going on for decades, and now people are much more informed. And local opposition is deep, and I don't know how to stop it, change it, or twist it. I just know it's reality, and it's going to get a lot harder for all of us, no matter what sector we're in.
I just want to tack onto that. Over the last 2 or 3 years, we've been spending a lot of time trying to think about investing in infrastructure in Colorado and Wyoming, and what are the risks associated with that, given the legislative movements out there. 5 years ago, I wouldn't even have thought about that. The Northeast has always been, that's a nettlesome place. I remember when Aubrey told me in 2009 that the Marcellus was going to do 7 BCF a day, and I said, you're absolutely crazy. We won't invest on that basis. And what is it, 30 something today, whatever it is, it's unbelievable. even with all the permitting issues in the Northeast. But I really agree with Mike on this. I mean, climate change, for better or for worse, was always tomorrow's issue. And given what's happening in the world, both in terms of the events we're seeing, but also the millennials, the Gen X, the Gen Z, they have a different view on this issue, certainly than I do. I only have to listen to my kids talk about it. And policy is going to reflect that. I think we're seeing that in Colorado and Wyoming. And it's not necessarily going to happen overnight, but it's going to shift. And I think the people who are most successful in deploying capital, whether it be in oil and gas or in electricity, renewables, are going to be those people that figure out how to play within that set of rules. Now, the president has been trying to do something about some of that here in the last couple of weeks, but we all know administrations change. They have different viewpoints. And at the end of the day, it is democracy. I agree with that. We have to work within the system that we have. Now, that doesn't mean we don't advocate, we don't work really hard to get the rules we want. But I guess I would say it's going to become more rather than less difficult.
Well said, Matt. And a comment you made about your investors concerned about hydraulic fracturing, there's two parts of this equation. There's education. We have to educate people because sometimes those positions are misinformed. But then there's also conforming to the new world we're in and recognizing that. Rinzai, you are obviously leading a public policy conversation this afternoon. Did you have a question for this group? Because it seems like this has been a perfect lead on to what you're going to be talking about this afternoon.
Well, I thought it was appropriate to talk to the capital providers for the industry. And in my professional life, outside of my volunteer work with OU, I run an agency that's built around the idea of how to help energy build the projects it wants to build. We call it social permitting. What I see time and time again is energy firms and capital where we'll invest $500 million, $1 billion in big projects and massively underinvest in getting permission to build those projects, only to later have protests, policing, regulatory delays caused by engaged stakeholders. And I would love your opinion. You've been talking the entire time about education of the public and engagement of the public. What is the appropriate investment of public into this space from a financing standpoint?
More.
A lot more, right?
A lot more. 15 or 18 years ago, in a place like Oklahoma, North Dakota, Kansas, West Texas, I would spend, on behalf of the company and my wider team, anywhere from $50,000 to $250,000 of resources to get a project permitted and ready to go. Places like California, the Northeast, maybe $1 million or $2 million. Same kind of project, generally back then it was wind or natural gas project, but generally that order of magnitude. Today, nothing's under $1 million, and if you go into the Northeast or California, you're looking at 10 or 12 million before you get the permission to put a shovel in the ground. On top of that is the county, state level, local level interaction, communication, networking with the officials before you ask for a vote, before you ask for this. What's also been added is more active tribal issues. The oil and gas industry learned this a little more, at least on the front page in North Dakota a couple of years ago. We've been living it for a long time, since 2010 or 2011 when I had a lot of effort I had to personally put into California and Arizona out near the border here with tribal issues. We now have a giant tribal relations group that now knows hundreds of tribal members in 20 or 30 states. We treat them just like elected officials. They consider themselves sovereign lands in many jurisdictions, if not all. No different than we treat the governors and the elected officials in every major state, or all the states where we make major investments in, I should have said. We are probably understaffing or under-resourcing that. And then I don't mean opposition. I think people want to see new energy, but they just want to see it done smartly. Most don't want it in their backyard, but I do believe most companies underestimate that. I know we probably did because of we were blinded by success, right? If the business kept working the way it was working for a decade, why change, right? If it ain't broke, don't fix it, the old adage. We've evolved quite a bit. I think the big new element that I'm learning real time the last 2 or 3 years, from a permitting point of view and a social policy point of view, is this thing called social media. We saw in the last 2 or 3 election cycles, or maybe just the last 2 or 3 years, how social media ran the election cycle in that industry, that business that affects all of us. Our businesses are much more impacted now, and I don't mean the marketing of discount coupons for diapers. I mean, that's definitely been going on for a while. But the permitting on the ground activity, the battle, pro and against a project, social media is a big piece of it the last 24, 18 months, and I think all of us are going to have to figure out how to get better at that also, and that's a real-time thing that many of us are under investing in. From the greenfield point of view, you know, the equivalent of E&P in our space, right? From an M&A point of view, ownership, who owns the actual asset, who's the corporate entity that owns it, that's a whole different education and social construct, right? Are you keeping the headquarters in Oklahoma City, or are you moving them to Tulsa or, you know, out of state? That's a whole different social negotiation when companies change ownership or change management teams or change who runs the show. But in our industry, I'm taking your question as the granular question on how do you get the approval at the low level. It's far more expensive. It's not going to get cheaper. It's not going to get easier, but that's why we get the risk premium for the return we're getting. If it was, I always tell everybody who works for me, if it was easy, you'd be down the street flipping burgers, because that's a risk-free job. You don't have email following, you don't have stress, you don't have pressure, you don't have to get a risk premium for your investors. The reason we're paying you that risk premium is to solve those problems. And I think the harder problems today are the logistics and getting permits and getting permission to build with public policy than it is public policy saying, well, we want a little less emissions or we want more green. I think that ship has kind of started turning, or has turned already. But to get that implemented, I think is underestimated by investors right now.
Let me just add one thing to that, because I think when you think about competition for capital, given how attractive the environment has been until recently for energy companies to raise money, the way I traditionally have thought about competition capital is the competition amongst the providers. But in this world today, you have to think about it as, you know, what is the competition amongst the users of that capital? We built a pipeline in 2009 from Wyoming to Malin, Oregon, serving PG&E's load, the Ruby pipeline. And we had all our permits in place, and we built this in partnership with El Paso. But what we completely underestimated was the ability of some constituents along the pipeline right-of-way to slow the process down. And we had a point in time where we probably could have settled that disagreement for $25 or $30 million. And everybody thought that made no sense. We ended up being $1 billion over budget on that pipeline because of our unwillingness to really invest in the local relationships. You know, this is a really important point, because, you know, we're looking at a couple of really interesting crude oil pipelines today. And one of the things that's really causing us to delay making any decision and leans towards not doing it is, you know, what is going to be the social impact? Are they going to be able to mobilize the way that people mobilized on DAPL? And what does that do reputationally for us? What do our investors think? There's a whole cascade. It's not just about economic returns. It may get built, and it may be a really attractive return, but what reputational damage do I suffer, or does my firm suffer in the interim, in the intervening period? These are all issues that are only going to be more germane.
I just maybe throw in one comment, which is, you know, economic alignment is so key. So I was a young guy in the late 90s, and we were working on a project for Noble Energy, and they had a project offshore Israel. At the time, it was just, you know, a concession. Nothing was really happening. And I was looking at the map, and there was a little block. This part was Noble, and there was a little block over here, I couldn't couldn't read the name, and I said, whose block, what percent is that? And the company said, well, that's the PLO's part. And so Israel and the PLO and all the terrible stuff that's happening onshore, they were partners offshore. And everybody was on the same page. This is definitely a good project. So my point is, you know, sometimes the companies get beat up for, you should have done more flyers, you should have done more community meetings, you should have done more visits, you should have done this, you should have done that. The truth is, you need to find a way that the people you're dealing with will benefit economically from your project. And this is the problem. You know, when somebody's up in arms, you know, what's the great joke about farmers in the US? They meet the oil and gas company at the gate and say, please drill here, can't wait for my check. And farmers in France meet them with pitchforks because they don't have any economic interest. So economic interest and getting people aligned is the key thing. You know, it's a tragedy what we're spending in the country. Mike might know the number, but you know, Dan Sullivan from Alaska had an infrastructure bill that he introduced. And the number was something like, for every dollar we're trying to spend on infrastructure, we're spending 40 cents on legal bills. So the tax on the nation of putting up with all of this stuff and not reforming it is huge. And it is very sad, to this point earlier, that the people in Massachusetts are paying $12 an M or whatever it is for gas. And the people in New York, I have a wife from upstate New York, it is a devastated place economically. And just across the border in Pennsylvania, they've discovered this thing called the Marcellus Shale, which happens to run into New York, and they won't let them drill it. So I think we are definitely going to need better leadership. My last point is, I actually think all this is getting better, because I think the anti-oil and gas, anti-development, anti-crowd has overplayed their hand. And when you get this debate, the good thing about the ESG debate is it's creating more debate in every place we go, but inevitably it's going to become a more honest debate. In the first speaker's slides, there seems to be one country that reduced their CO2 emissions, and it's us. And it's because we're fracking and using natural gas. So this storyline, I would be optimistic it's going to change, because it's not rational. It's not right. And my favorite thing to tell my son when he calls me and asks me about something he doesn't understand is, I like to say, stupid stuff does not last. And we're doing a lot of stupid stuff in this category, and I'm just optimistic it's going to change.
Well said. Got a question right over here. Mike, how are we doing on time? Okay, thank you.
The question's still on? Okay. I'm just curious, Matt, you mentioned in raising this new fund, some investors asking for carve-outs about fracking. Do you have views on, in the spirit of what Maynard just said about overplaying the hand, do you have views on how far the campus-based divestment movement goes, how material it is to the supply and character of capital in the industry?
You know, I think that movement and movements by, you know, sovereign wealth funds in certain parts of the world to divest themselves of hydrocarbons, I think that's going to continue. I think it will actually accelerate. I'm not sure that will be, there's so much capital potential out there. And just look at my world and all the you know, pension fund capital coming out of the Middle East, China, Singapore. I don't worry about there being a dearth of capital for the things that need to get done. I think that I think the biggest thing to watch, and Mike was talking about this, and I agree with him. The oil and gas, you know, companies and the electricity companies are not natural bedfellows. They're not, you know, that's not a marriage made in heaven. But I do believe that the pressure, while it will be long dated, for the oil and gas companies to change will continue. And I think it will be political. I think it will come from the investor bases, ESG and other places. And I think ultimately, dislocation and change yields opportunity. And I think there's a reason why BP and Shell and Total are trying to figure out, you know, where can I create a business model using the asset base I have, and investing $1 billion to $2 billion a year in different technologies, trading, customer positions, to try to understand how am I going to make this transition. I see the CEOs of those companies on a regular basis, and they're certainly not going to compromise what is an unbelievable business in oil and gas, but they're aware of the change. And you don't want to be the CEO that missed the change, that was left with a set of legacy assets that didn't make the transition. And I'm not arguing that it's going to happen, you know, right now or even in the next 20 years, but it's going to happen by the end of the decade, or by the end of the century.
Well, I think as we conclude, I think we can take one more question if there is one out here. I'll put a hand right here. Henry, we get a microphone to Henry. While he's doing that, I think it's important to recognize, although I don't think we'll be doing kumbaya like Mike says, it is important that we maybe lean more towards that than coexistence. There's a lot of cooperation that's going to have to take place to do the things that all three of the panelists are talking about. So I keep wanting to be hopeful and be encouraged. Henry?
All right, thank you. For years, we have been talking about natural gas as being the bridge fuel to get us to the needs for a reduction in CO2. We talk about it as being the only clean alternative for fossil fuels. It was reinforced today by a Stanford professor. But we have a problem in the market today that we have essentially two gas markets. We have gas being produced by companies who produce gas for a living and need a reasonable rate of return to justify continuing investment. And then we have gas being produced by oil producers as a byproduct where they have already recouped their investment through oil production, and they're flooding the market with essentially a waste product. So how do we reconcile this, and how do capital providers see this dichotomy going forward and picking an investment choice to ensure that we're going to have natural gas produced in this country to meet the needs that we're talking about?
Let me answer from the electric side. 15 years ago in this country, nuclear and coal was 70% of the electricity. Today it's about 50. Doesn't matter who's in the White House or who's running Congress the next 10 or 12 years, that 50 is going to drop to about 30. And it has nothing to do with tax policy, it has nothing to do with renewables, it has everything to do with cheap natural gas and cheaper renewables. Market share of that and load growth in the country, in the U.S. from a natural gas, nuclear, coal, renewables point of view is relatively flat the last 10 years in the U.S., and we can argue that's a whole different conference. Why that's happened? It's going to be generally flat the next 10 years. So basically the 18-inch pizza is going to get cut differently. We're going to cannibalize, or not cannibalize, grab market share from those other fuels, and it's going to roughly be half natural gas, roughly half renewables. When you look at it state by state on who can burn natural gas, who can even get a permit for a gas plant, or who can get that cheap gas or off, wet gas or whatever, export and get it to electric generation, and what the economics of that is, state by state, those decisions are made. And the basis differential back, just like the oil and gas business has basis, there's basis in electricity every day too in the trading, and how expensive it is to get it to different jurisdictions. Same with renewables. The basis within a state can be 10 or 20% or 30% of the project, of the sale price. So when you look at all these granular little LMP or little nodal decisions that are being made in the electric sector, it's driven by natural gas on the margin, almost all jurisdictions, almost all. And when you look at that 20% of our energy space, consumption is going to get resorted. It doesn't matter who's in the White House. It doesn't matter who gets reelected, whether it's an Obama-like presidency or a Trump-like presidency or a Bush or a Clinton, it doesn't matter. Economics are driving those decisions. Public policy is influencing it, to some of the questions before, as evidenced by takeaway or capacity to get it to the burner tip. But on the electric side, natural gas is going to be here to stay, and it's going to have a giant chunk of electric generation for a very long, long time, along with renewables. And we're not, as someone said earlier, we're not going 100% renewables. I think Matt said that. And it's going to go up maybe another 5 or 10% the next 10 years from 8-ish today, not counting hydro. Right, I'm talking wind and solar. 8 might go to 15 or 20 over the next 10 years, but it's not going to 100. It's not economic. It's not going to make sense. It's the equivalent of growing orange groves in North Dakota and forcing North Dakotans to drink orange juice made from their orange groves. It would be $200 a glass, right, due to the climate. And natural gas is an economic fuel and an economic developed weapon that's good for our economy when it's as inexpensive as it's being delivered today at the $2 to $4 range.
I would just say, Henry, that I think a large part of your answer to your question revolves around the continued proliferation of a global gas market. And you know, the markets tend to be pretty efficient. I think one of the ways that Exxon and BP and Chevron are managing this transition is they're becoming bigger gas players, and they're stepping into LNG. One of the reasons why, when everybody thought we had a big glut of LNG over the last 3 to 5 years, all of these new demand centers like Bangladesh, Vietnam, certain countries in the Middle East opened up as importers. And what you're seeing now are these, and the issue from my perspective with those countries was, are they financeable? What's the credit risk? Well, Exxon, BP, Shell, they can take that risk. Vitol, Trafigura, Glencore, they can take that risk. So you've got these portfolio LNG players that are emerging that are going to bridge all this excess supply that we have in this country with all this growing demand, which is going to be essential to lifting a lot of these countries out of poverty. And I think that's one of the ways you'll see, you already are seeing these big energy companies manage their reputation in terms of being a participant in cleaner energy. Natural gas is, somebody said it earlier, a bridge fuel. It is a bridge fuel, but I think it's more than that.
I just maybe throw in one dose of optimism for you, Henry, which is I think that problem you're referencing, the oil guys just producing and who cares about the byproduct, that's probably most pronounced in the Permian. And what I think is fascinating about that problem, and it's a problem, and so we're going to get just so much gas that we just don't know what to do with it. So that's a near-term real issue. But what I notice about that problem is it is forcing people to figure out, what do I do with that natural gas? And some of the things we've been talking about, ESG and other pressures, you can't just flare it. Like, you got to figure out something to do with it. And so the developments at the wellhead, one of the neatest trends going on, electrification has been mentioned many times, but the ability to take field gas, do something with it, convert it to electricity, start powering, maybe you do electric fracking, things like this. I think that problem you're talking about, I think it has all the elements of being an incredibly positive thing, because it's going to force the industry to do a lot of stuff over the next 5 years. And so I'm really excited about it. And I think we're going to see a lot of innovation from that problem. I guess my last point is hang in there, because it's the best fuel on the planet, period. And eventually we'll figure it out, and eventually it won't, the price will be a little bit more, so you can make a little bit more money.
Well done. Well, please join me in thanking our panelists for coming so far. Appreciate it.
Thank you.